So, dear students, we start with capital gains. Capital gains is the fourth head of the income, and if we talk about the earlier heads, we did salaries, we did income from house property, we did income from profit and gains of business and profession. This is the fourth head of income, and the capital gain is calculated. This is the basis of charge that we calculate all the gains on the assets which are transferred in the previous year, and depending upon the holding period we can say that either the asset is a long term or it is a short term, and accordingly the tax is calculated. So here we can see that the period of holding is either you can see 12 months or 24 months mentioned or 36 months mentioned. So it means something to do with the time period. So let us quickly go through this image, that in case we are talking about a security which is listed in a recognized stock exchange, or we're talking about UTI units which are transferred, then if their holding period is less than 12 months or it is equal to 12 months, we will say it is a short-term capital asset. And if the holding period is more than 12 months, we'll say it is a long-term capital asset. Similarly, if we are talking about land and building or either unlisted shares, in that case, the time period is 24 months. Less than and equal to 24 months holding period will make it a short-term capital asset, and holding it for more than 24 months, it will make it a long-term capital asset. And there might be many other assets apart from the units or securities or shares, listed, unlisted. So what to do about them? So for example, let us say we are talking about jewelry. So in that case, it falls in the other assets category, and there the time period will be, it will be on the basis of 36 months. So less than equal to 36 months, it will make it a short-term capital asset, and holding for more than 36 months would make it a long-term capital asset. So now the question arises, what is a capital asset? So section 2 subsection 14 defines it, that it can be any property which is of any kind. When I say kind, so it may be movable, immovable, tangible, intangible, fixed, floating, and it has nothing to do whether it is connected with your business or profession. Even the commercial property, the residential properties which in which a person is residing, or the personal jewelry, whenever that is also sold, so it will attract capital gains. So the second part of the definition says that any security which is held by the FII, that is the foreign institutional investor, which has been invested in any security which is covered under the regulations under SEBI. Let us quickly go through that what are the various examples of capital asset, or land, building, jewelry, plant, machinery, goodwill, debentures. Yes, in case of when I say these goodwill, then it means it is a self-generated asset of the business. So it means self-generated assets are also treated as capital assets, and the other self-generated assets are like tenancy rights, stage carriage permits, or loom hours, or the right to manufacture, right to produce any article, or right to carry on any business or profession. So they all are covered under the capital assets. So there are some things which can be called as assets, but they are not to be treated as capital asset for the purpose of income tax. So their examples, or we can say the exceptions to the rule of capital assets, are stock in trade, that is the commercial goods in which the business is dealing. Then movable assets for personal use, for example your own car or your Activa or your bike which you are using, that is a movable asset. Apart from that, your refrigerator at home, your television at home, your laptop, or any other electrical appliance which you are selling will not attract capital gains. Then but there is certain exception to this. In the earlier point we did jewelry, so over here remember jewelry is also a movable asset, but that attracts income tax in case you transfer it. So another things like these are archaeological collections, drawings, paintings, sculptures, or any art form, artwork, that all if you sell, so that will attract capital gain, no doubt that they are movable assets. Okay, so coming up next is the agricultural land. So agricultural land, the rural one, it will not attract capital gains tax provided it is beyond the range of 2 kilometers from local limits and having population of less than 10,000, not more than 10,000, we can say. And then uh, another point is the gold bonds, 6.5% gold bonds, 77, or national defense gold bonds, 1980, which are issued by central government. Then special bearer bonds of 1991, gold deposit bonds under the gold deposit scheme 1999, or gold monetization scheme 2015. They are all not to be taken up as capital assets, or rather we can say in a simple way, you sell them but there will be no capital gain tax on that. So as earlier said, we said it depends upon the holding period, that whether the asset is long term or a short term. So a short term capital asset under section 242A, it means a capital asset which is held by SSC for a period of 36 months or less, or we can also say it like this, which is held by a SSC for not more than 36 months immediately preceding the date of transfer. So this 36 months was reduced to 24 months in case of unlisted shares and land and building case from financial year 17-18 onwards, and it is applicable for your financial year 2. So the other leftover, that is the other assets like equity or preference shares or listed securities or units of UTI, zero coupon bonds. So in that case, the time period is, holding period is not more than 12 months. Here I would like to add one more thing, that assets which are used for business and on which depreciation is allowed on written down value basis, they will also be treated as short-term capital asset. Long-term assets, now exactly the same things which we did early in the earlier slide, but only the thing is instead of less than, it is more than. So I have highlighted that part so that you are able to understand more than. So one thing I would like to make very much clear, that land and building in that case, if it is transferred up to 31st March 2017, then we will be taking 36 months as the time period, the holding period as a test. And then if it is transferred after or on 1st April 2017, in that case the time period is to be taken to be as 24 months. So for now, for your financial year, it is that suppose if the asset, that is the land or building, is sold after holding for 24 months, then we will say that it is a long-term capital asset. Transfer of capital asset, this is the next part, very important for theory question 2, and one must understand these words, that what is, when we say that when we transfer a capital asset, then whatever gain is arising, that will be treated or taxable as either long term, short term. So what is the meaning or definition of this word transfer? Transfer means sale also, exchange also, relinquishment means voluntarily you give up something. So any asset you have give up, or you have given up any rights, or even if any government has taken anything compulsorily under law, that is compulsory acquisition under any law, then all these things will be deemed to be as transfer. But now there is a list which you can see as under starting that these are not regarded as transfer. Let me make the thing clear कि इनमें भी assets or the things are being transferred, but they are not regarded as transfer for income tax purpose. For example, an HUF was there, and there is a partition seen now, and the assets has been transferred to the co-partners. तो वो जो co-partners को assets मिली हैं, they will not attract the capital gain tax because it is not being considered as a transfer. So similarly, if anything or any transfer of asset has been under the there was some loss of connection. So either if anything has been transferred as a gift or under will, then again it will also not be considered as transfer. So you can see the things in the next slide, that all the transfers, they are transfers but not for income tax purposes, will not be treating them. Question arises how to compute the short-term capital gain. So go step by step. The first step is calculate the net sales consideration. वो कैसे आएगा? That you have to calculate whatever the sale price is received, then from that deduct all the expenses incurred on transfer, for example, any brokerage or commission paid to someone. Then from that net sale consideration, deduct the expenses of acquisition. Mind it, this cost of acquisition means how much amount was paid in case to acquire that asset. So in case it is given improvement, improvement means anything, for example, any addition done to the asset. So whatever is left, that will be called as either short term or gain or short-term capital loss. As you can see, the index cost of acquisition is to be computed as whatever the cost of acquisition is there. You have to multiply the index in the year in which asset is being transferred. Of course, it will be your financial year only. So the index of that is to be taken in the numerator and divided by whenever that asset was acquired. Suppose you acquired it before 2001-2, that is our base year. If the assets were acquired before that, in let's say 1999, 1995, so we are always going to take the base year index, and that is 100 only. So similarly, in case of cost of improvement, any improvement which was done prior to 2001-2, we are going to ignore that. We are not going to consider because we are only going to take up the starting index 100 in case we are talking about a time period which is earlier than 2001 or 2. So what is the formula of indexing cost of improvement? That is cost of improvement multiplied by cost inflation index in the year in which the asset is been transferred. Again, it is going to be your current year only because we are going to calculate the current year capital gains. So divided by the index in the year when the asset was improved. Now mind it, what the improvement can be. For example, in case of house property, we had only the ground floor built, and then in the year 2005 we built the first floor, and in 2010 we built the second floor. So the building of first floor or the second floor part on the house property, that means that we have done certain improvement. So what these cost inflation index are, you can see in the next slide. You need not memorize these indexes, but at least the base year and the current year both should be there. The rest would be provided in the question, of course, by the paper setter.